title of my little talk here is How Our Money Caused the Economic Crisis. And I'm going to focus mostly on the U.S. here, because the U.S. dollar has been the reserve currency of the world for a good 70 years or so, a little bit more. And if the dollar fails, then the rest of the currency system fails as well. So we got this money system. I'll give a little bit of history of that. So we have this virus, and people are looking at the crisis as a virus-caused thing. That is something we did it to ourselves, so we can just flip the light switch back on, and everything's going to be fine. So, but let's just start with a few basics here, because people get caught up in the idea of money and what money is. So let's imagine for a second that we have 5 or 10 or 20 people stranded on an island, and we have to produce. We have all these resources here, but we don't have any food, to eat. We don't have any shelter. We don't have any, firewood. So we have to. But there is wood around. We just have to, sort of produce it. So we got to, cut down the wood and come up with a tool to do that. Someone's got to go get some fish. And so, essentially, we have to produce things, and then you can produce things and trade them with each other, and that's essentially money. It's barter. But sometimes people don't have the right ratio of logs of wood that you've cut down to the number of fish, or to a spot on the island or anything. So it's a naturally occurring phenomenon, the creation of money. I mean, that's why in prisons people trade cigarettes around. It's not a warden created thing. It's not created by the government. It's created naturally. We have resources, and we take that and apply it to the current system that we have today. Now, a little background for this chart. On the one hand, if you produce, you can consume what you produced, or you can have more than you need to consume, and you can trade it, or you can just underconsume and save. And so when you have a lot of production, you have a lot of abundance, you have a lot of savings available. On the other hand, you have people that want to borrow. It's savings and people that want to borrow. And that interplay between savings and the supply and demand of savings produces a price. It's an interest rate. Now, the problem is that happens is you introduce a third party who like a central bank in the US, in Europe is the European Central Bank. It just picks an interest rate, and they're just picking it out of thin air because they don't, they're not depending on the supply and demand for savings. They give themselves the right, or the governments of the countries have given them the right to print money, and therefore create a lot more supply of money. But that's not supply of stuff, of production, like the island example that we have there. So they can, if they have the power to print money, they can just pick an interest rate. And so essentially that price fixture, when they guess, they often pick one that's too low, below the market clearing rate. And the reason they do that is because for political reasons, for short-term being elected, getting reelected, they don't want to have a crash on their watch, or a recession on their watch. So they lower their interest rate and they create a big boom. And by the time they're gone, then all that money that was borrowed with a low interest rate, because people rates are low, you're like, oh hey, I can get more money. I'll do it. I want to buy that car. I want to buy a new TV. I want it now. I don't want to wait and save. So you get a big boom, and then people have to pay back that debt. So that causes a bust. Now the next people that are in office, they don't want the bust to happen on their watch, so they'll cut the interest rate again. So you get this massive production of the currency that reduces its value over time, which hurts people that are saving money, which hurts people that earn wages. So you can see from 1900, there's a bump in 1913 here, when the Federal Reserve was created, the U.S. Federal Reserve. From there, the U.S. dollar has lost, this only goes to about 2011, but it continued until today. It's lost about 95 to 97% of its value over time, which is, you have a currency that's losing value, you're not going to want to save that. So we have these very low interest rates. Now, this table, how did that happen? And this table tells us a lot about how that happened. So, or this chart goes back to 1945 or 48, I guess. But in 1945, after World War II, the world's top countries got together and said, hey, we need to create a new monetary system. And who has, all this? Where's all the gold? Gold was money for centuries. And lo and behold, the U.S. had 95% of the world's gold because in the late 1800s and early 1900s, it's a very productive economy. People, they had low taxes, low regulations, very little government spending. And so they were able to produce and trade to other countries. And so that the other countries were sending in gold. So the U.S. had 95% of the world's gold. And so they got together, it's called Bretton Woods, at Bretton Woods, and they created this system that said the U.S. dollar is going to be backed by gold. You have $35, you can bring it to the U.S. Treasury and they give you an ounce of gold. And all the other currencies were going to be backed by the dollar at a particular rate. So if it was all fixed to gold, with gold as the bottom of the inverted pyramid. Problem was that once the U.S. got that privilege of having the world's reserve currency, meaning people would, whenever they earned things, they could, whenever they earned money, they would save in dollars because they could get interest. If you just held gold, you had storage costs. But if you held dollars, it was backed by gold, and you had the ability to turn it in for gold, but you got interest, so it's a good deal. Well, it was a great deal for the U.S. because, once they got that power, they abused it. In the 1950s and 60s, particularly the 60s, a lot of huge spending programs, borrowing money to pay to go to the moon, Vietnam, Great Society, which was this sort of giant welfare new program with started with Medicare and Medicaid and a number of other things. There's just a lot of spending, and France and Germany in particular, and a number of other countries said, we don't think you guys have enough money or enough gold to cover all these dollars that you're borrowing. So they started calling in the debts. They said, okay, send us the gold. And so gold started flowing out of the U.S. And the 95% went down to about 45% by 1971. Here's the 1971 you see right here. So 1971, so much gold was flowing out. The U.S. president at the time, Richard Nixon, said, hey, you guys can keep your dollars if you want, but we're going to renege on this promise. We're going to default on this promise to give you gold if you have $35. And you can just keep the dollars if you want, but you're not going to get any gold. Now, the whole world should have gone on their own gold standard at that point, but they didn't. They kept the dollars. Now, more specifically on this chart, okay, so keep that background in mind for this chart. So 1945 to 1971, this productivity line is a measurement of how much we produce, the abundance that humans produce per hour of person work, okay? So there's different ways of measuring it, but generally with technology, with humans coming up with new ways of doing things, producing more abundance, that productivity line goes from bottom left to top right. We produce more with less effort. And as you can see, the hourly compensation here, the light blue line, went right along with it, as long as gold was backing the currency, because the currency holding value relatively tends to push up wages. It creates supply and demand for labor, which causes laborers to be able to demand more in pay. But since the dollar broke off from gold, that hourly compensation it flattened out. It's essentially barely moved since 1971. Whereas the productivity has gone, bottom left to top right, just like normal. Well, the problem with that is that all that productivity went somewhere. Where did it go? Well, it went into asset prices, stocks, bonds, real estate, and who owns those things? Rich people. The rich people got a lot richer since 1971 because the currency is not backed by anything, and so asset prices have gone crazy, and wages and savings of poor people have gotten less and less valuable. So they've fallen behind. And, 1971 to 1980, you can see in this chart here, this is the interest rate that this central bank set, the base interest rate that they, remember this one that they pick out of thin air, right? From 1971, right about here, after the dollar was depegged from gold, gold went crazy. It went from $35 an ounce up to $850 an ounce. I mean, that's not the gold getting more valuable. That's the dollar losing value because it was allowed to appreciate the gold. And oil went from $3 a barrel to $30 a barrel. It wasn't Iran. It wasn't oil shock from real oil. It was actually just the dollar losing value. So much value was being lost from the dollar that the central bank stepped in and raised the interest rate up to over 20% here in 1980. That saved the dollar. It saved everyone from rushing away from it. So that dollar reserve standard was kind of born. Instead of the gold standard, we had this dollar reserve standard. People still save in dollars. I mean, they were the reserve currency, but the U.S. government can just pretty much print as many of them as they want to pay for their spending, because they have this brand of being gold. Well, as you can see from then on, it went down, with nothing goes straight up or straight down, but just the trend is definitely down until today, where we're at 0% interest rates. After 2008, which is a low interest rate created crisis that caused housing prices to go crazy. Then that imploded, and the banks were about to go under, and they cut interest rates to 0. So then they've kind of bumped up a little bit, but now we're back down in this virus, back down to 0, and people are talking about whether the Fed funds rate is going to go negative. All right, now what does that all mean? That means we're at the point where this crisis, a crisis has been building up for decades, and it's about to just be unleashed on the world. And so the way to tell it, like if you're trying to invest your savings, the way to tell where we are at, where we're at in this cycle, is the Dow to gold ratio. The Dow is the Dow Jones Industrial Average, the U.S. stock market, and gold is gold. So for 1 ounce of gold, in 1929, which is this peak here, which is the roaring 20s, and then we had this 1929 stock market crash that caused the Great Depression. 1929, it reached a peak of about 18. So you could take you could take 1 ounce of gold, and you could buy 1 ounce of gold with 18 times the stock market. So the stock market was worth 18 times 1 ounce of gold. So that was the peak in stocks, and that fell to under 2 in 1932. The big crash. They started printing a lot of money, and so the gold the stock market got stronger, and it peaked again in 1965 about at 28 or so, and then in 1980 it fell down to 1. And since then, from 1980 until the dot-com bubble in the 90s, and the dot-com huge one up in the 1990s, it peaked about 40, and then until 2008 it went down to about 8, and now it's risen up until just recently to about 20, and now it's about 15. So before this is all over, it's going to go all the way back down to 1. And that's because the currencies the dollar's losing value, as we saw in this chart here, and so they're printing so many more dollars. I mean, just in the last month they printed about 4 trillion of them, and it's no end in sight. So all those dollars are just going to collapse the value of the dollar, and that reserve currency status that the dollar has is going to be taken away, because that we're borrowing against that brand, and that brand is losing its value fast because they're borrowing so much against it. So as that goes down to 1 or 0, whatever it is, I mean, not 0, but as it goes down to a 1 or so, then it might be a time to buy stocks. But there's a lot of chaos that will ensue as people's savings and their wages are just being decimated if they're holding dollars. So first of all, you got to make sure you have some dollars, or you have some gold, and also maybe some Bitcoin or something. That's a new thing in the last 10 years, but it's the same idea essentially for this purpose as gold. Now where are we in this kind of in the very short term? Well, this is a very interesting chart I just came across yesterday, and it really just brings us to the present, almost day or yesterday. So in 2008, remember we had that big run up in housing, and a lot of debt. People were taking on to buy houses, and corporations took on a lot of debt. I mean, there's just a lot of debt because if interest rates are low, people are going to borrow a lot of money. So 2008, there are two lines here. There's downgrades, which is you have ratings agencies like S&P and Fitch and Moody's. They take the whole corporate bond universe and they say, okay, this is AAA, this is BBB, or double B, and they say how risky the bond is, and people buy those bonds. And the higher the risk, the more interest rate people are going to demand for loaning money to those companies. Well, as a credit bubble bursts, the first thing that happens is that the ratings agencies downgrade those bonds, and downgrades precede defaults. So as you can see in this chart, like in 2008, in 2009, those crises, those downgrades shot up to a record at the time. And then about 3 or 6 months later, defaults, like companies just started going bankrupt, and including some banks, and that credit collapse is contagious. So banks are holding a lot of debt, and they go under if everything really just unravels. So central bank cuts rates again to avoid that happening, and we continue that cycle of the dollar, of the currency collapsing. So right now you can see today, like literally, we are right in the eye of a storm. Like we had a tsunami in March, in the stock market and the bond market. People were just dumping everything they could. This virus is keeping people home. People aren't going to have, they're not going to be able to earn any money. They're not going to be able to, they're not going to go spend. And so the whole thing, the world stopped, right? Essentially, in a lot of places, locked down. So downgrades exploded, but the default rate has not yet run up. And right now, in the last few weeks, the markets have started to seem a little bit more calm. And there's this sort of FOMO coming on kind of feel in the markets. People are like, well, stocks are, maybe I'm going to miss this. I don't want to I don't see anything happening in the economy, but like, I don't want to miss out on Microsoft or Apple or, some of these Facebook or something going up. So I'll just, never mind. I have a bunch of cash because I sold at the bottom, in March. I'll just buy these stocks. And that's exactly when the next wave of the tsunami comes and just rocks everyone who doesn't know what's coming. So that default rate's the downgrades are at an all-time record right now, 800 in the last. So in 5.5 months in this year, there are more downgrades than in any whole year in history, and default rate is about 4%. So the default rate's going to explode. It's going to go above 12, 14, I don't know. It's going to go a lot, way high. And remember the chaos in 2008. So you can imagine the chaos that we're going to feel now. It's going to be much bigger, especially if the dollar loses its reserve currency status and we have that real collapse in the value of the dollar, and gold shoots up. So, I guess I'll stop there. And if anyone has any questions or discussion they wanted to propose, I'd be happy to hear.
Thanks for your speech.
Joe, thank you. Can you hear me?
Yes.
Hey, I think you made a really strong argument for why it's so politically difficult to kind of stop the spending. Dick Cheney famously said, deficits don't matter. Do you think there's, I guess, is your prediction that this current crisis will basically, get rid of the dollar as the reserve currency, or do you feel like politicians would make some move to try to protect that reserve status?
Well, so the easier thing to do is just to print money because it's the short-term fix, and that's what politicians are concerned about, and people that are in office are concerned about, because they don't stay forever. They want to, they want to keep their job while they're there. So that's why it's much easier just to print instead of raising taxes, because that's not politically popular, or cutting spending, that's not politically popular. Once you start spending on something, as they say, there's nothing more permanent than a temporary government program. So you have the easiest thing to do is just like the path of least resistance is just keep printing. And so, yeah, the reserve currencies, I mean, the central banks have control until they don't. And the markets are a naturally occurring phenomenon. They're bigger than the government and central banks. I mean, just look at that island. The island is not, it preceded government. So you go on that island, there's no government. It's nature. Nature is above our socially constructed human structure. So essentially, they'll print until the market tells them that they can't anymore. And the reserve currency status, I think, it will disappear for sure. Because we have so much more debt than anyone else. The U.S. does. 25 trillion. I think a month or two ago it was 20 trillion. It's just exploding. Anyone else? Or Neil? Anything? You happy to hear your comments or thoughts?
Yeah, it's just for me, it's a lot of knowledge about dollars, because I'm not, I didn't have a background in fintech, but it's for me a huge information. Thank you.
Thank you.
One last question. You talked about investing in gold. Would you have a recommendation as to what percentage of your portfolio should be in gold?
Well, I personally, I'm kind of all in on not just on precious metals, but on crypto as well, but much more on precious metals than crypto, because I'm not totally sure how that plays out. It's only 10 years old, but it's like you don't want to be fall victim to the idea that what Kodak did with Instagram, digital cameras, and what essentially digitization of everything is killing all the prior things. So yeah, I want to have a significant allocation to crypto too, just because it's new doesn't mean it's not going to work. But I manage money for maybe 9 or 10 close friends and family now, and I don't think it's right to be investing all of their money in that. So we have about 40%, I would say, in gold and gold stocks, particularly gold stocks. I mean, and silver is the silver to gold ratio is out of whack too. I mean, historically, when gold gets 100 times or 80 times more valuable than silver, the ratio is over 80 times. And silver is very cheap, and it reached 120. It's more than ever in history, just about a month ago. Now it's down to about 100, but still that's still very high. So silver is a better bet. It's a little more volatile, but it's a better bet than gold in the short term. And I think that's going to go up. It goes down more when gold goes down. It goes up more when gold goes up. And gold stocks are leveraged to the price of gold because they pull out gold out of the ground with a margin, and so that if the price of gold goes up, that their margin increases more than just if you had gold bullion in your hand. So yeah, I don't know, that everyone's got their own idea of what percentage, their own risk tolerance. Some people maybe 5% just to make sure that you don't lose everything you have when currency collapses. But yeah, we're about 40%. Anyone else with any questions or thoughts?
Hey, I don't want to monopolize this, but
Okay.
while I have you, you're such a great source of a wealth of knowledge, if I will. Do you want to make a prediction as to when the crisis will occur, such that the U.S. loses its reserve currency as the dollar, or the world loses the dollar as the reserve currency? I know predictions are tough, but that's my final question.
Well, I mean, this chart is fascinating to me. I mean, and I literally, like I said, I just came across it yesterday. Let's see if we can get back up there. Slideshow. Share. Yeah, I think you can see that now. So, I mean, that literally, like, these things, these two lines should follow each other. Downgrades from the ratings agencies and the default rate on corporate debt, and they're just totally out of whack right now. And that's that's because one follows the other, and the first one has moved up and the other one hasn't. So we're right in the middle of it. I mean, the collapse. There's a series of stages. There's the downgrades, and there's defaults on corporate debt, and then there's printing of money, and then the printing of money flows into the world economy, pushing up prices, consumer prices. I mean, already it costs 8 to 10 times as much as it did 2 months ago to fly from Puerto Rico to New York City. Business class ticket was $300 or $340 a couple of months ago, and now it's $1,800. So the supply is being constricted, and they're printing a lot of money, which pushes up prices. So, if China's holding a lot of dollars, they're holding a lot of treasuries, and Japan too. Anyone who's sitting there holding dollars, like, we're going to dump these, and that is almost like the definition of losing reserve currency status when everyone dumps your currency. So timing is, I mean, we're not far, but I don't know if it's this month or 6 months or next year or whatever, but closer and closer.